see everybody. Alrighty. Beautiful, beautiful. All kinds of fun. We're going to hit on what's happening. You ready? We're good?
Yes.
Beautiful, beautiful day in paradise.
I'm ready.
All right.
Ready? Okay. All righty. In 3, 2, and 1.
Hey, folks. Welcome back to your Frederick Real Estate Update. I'm Darren Ahern with RE/MAX Results, bringing you now almost 24 years experience, getting closer to that big day when I got licensed that many years ago. And I have with me the man, the myth, the legend, Presidential Bank Mortgage on his big birthday.
Thank you, Terry Kernan.
Yeah, happy big day.
Yeah, number 64.
64. There you go.
64's in the books.
Man, he gets to retire next year, I guess, right?
Yeah.
You get the privilege and honor of that if you want.
Yeah.
It's all about what you want to do out there, right?
Absolutely.
But we're doing a recording, but we had to say happy birthday to the Big T and appreciate you, brother. All righty, so let's dive right on into it. Obviously, we want to thank all of our listeners, everybody that's tuned in for many, many years. And you can go back in the WFMD and the drop down, and you're going to see now it will be 473 programs. So we have covered a lot of real estate mortgage stuff, a lot of ground. This is your weekly dose of mortgage updates and real estate updates and the craziness as the real estate and mortgage world turns, as they say. We're turning and burning. We're being flat sometimes. We've seen a lot of stuff, and it's no different today. We are going to dive into a topic that you told me earlier. I don't know if I've ever seen this before. That's like a pilot that has flown a plane for 30 years that says, hey, Cap, hey, Mr. Sub-Captain, or whatever they call him, co-captain and co-pilot and stewardesses and passengers. I got an announcement
debate. Flight attendants. We're going to move you politically correct.
I know. I just go way back in the day. Flight attendants. Anybody that's flying on the air with us, not if you look out to your left or your right, here's what you're going to see. We would like to let you know of something that we've never seen before. And nothing bad, just we've never seen it. We'll see what happens when we all get there. So that's what it is on this August 1st, T. And the cool thing is this. Make sure you like, subscribe, share with everybody and all that good stuff. And don't forget, I have the big podcast too on Monday night, 7 o'clock. Everything Frederick Live that we are doing real estate updates there as well. So make sure you check that out. And that's on YouTube and everywhere else as well. All right, T, guess what? Inventory. We're just hitting it real quick. We're not doing deep dives because we're going to talk about some stuff that's wild in real estate mortgages. 705. What do you think of that?
Okay. Steady Eddie.
Yeah, steady. Last week we're at 710. So we've been seeing it creep up, flatten out, get down a little bit, creep up, flatten out, get down a little bit. This has been the case for 6 weeks now.
Well, and I say it on the show a lot, and I say it whenever I talk to people. I can sell stability.
We're selling it.
I can sell stability. This is a good sale.
Yep.
Above 700 is a good number for what we've been dealing with over the last 6 years.
Yeah.
So based on the last 6 years, 705 is one of the highest numbers that we've been at in the last 6 years.
Oh, no doubt.
That's good, and I can sell stability.
Exactly. And it's good in the sense that buyers have more to select from. Terry, there was, just like we have sellers with delisting, rage delisting, we call it when they don't get the price they want. We had buyer rage. We called it inventory buyer rage because there was a day then we had 100 homes on the market in Frederick County for sale. And anytime it was, like you said, below like 500, sellers were mad, buyers were mad. They were like, this is it. My whole entire search, I got 5 homes to pick from or 10, and now they got 20 or 30 or more. So you're right. It's a whole different ball. It feels to be a different ball game. But we just don't want to go over 1,000 or 1,100 because that's when we'll see prices like really take a nosedive rather than a little correction. So all coming soon's 94. That is up a little bit. Last week was 83. So
good news.
I don't know if those are the sellers that are like, hey, we're going to miss the party. The longer this party goes on, the less champagne's left and the last margarita glasses left over. So let's get some. But 94, yeah. And under contract, 525.
That's a big number.
It's good. We've been in the 300s and 400s for a long time, so we'll take it. And then sold. Last 30 days, 343 in the last 30 days. That's 10 to about 11 homes a day. that are selling in Frederick County. But let's take you back in time. Now that we're through July, now that we got 7 months under our belt this year, we're going to go ticking them back just a little bit. We're going to go back to January 1st till today. So what's happened in 2026, and then we're going to compare it to 2025 on a year-to-date time frame. So year-to-date right now, we have sold in Frederick County, there's been 2,084 homes that have sold this year. Okay.
Year-to-date.
Yep, year-to-date. So guess what I did? I missed that one number. I can't believe it. I have to go back and revise it. But from recollection, it was a little bit less. I think it was 1995. I think we're up about 100 houses that have sold year-to-date this year versus the same time at last year. But here's the fun part. New home sales this year, 178. And we've had 1,906 resale homes. This year, the average days on the market so far averages all to be 36 days and a 98.8% sale list price ratio. The median price, $490, and the average is $528,782. Now, let's look back at 2025. 2025, instead of 178 new builds, there was 237 last year. There are substantially less brand new homes selling this year than last year. Why is that? What's going on?
Probably less inventory and probably the costs continue to rise on new construction. We see it every day. So I think the builders are, might be having two things. One is getting, I talk about the funnel. You put the farm in at the top of the funnel, and out of the bottom of the funnel comes finished lots. That could take up to 10 years, or usually takes 10 years. So maybe there's a shortage of lots out there, which I think may very well be the case. But we're also, looking at the cost of construction continues to go up.
Yeah, it does. So these two numbers combined will give us actually the year-to-date for last year's, because of 237 brand new homes sold last year, and there was 1,731. Terry, you're the mathematician over there. Come on now. You're the lender. You do numbers all day. I don't. 1,731 homes at this time last year. This year, it's 1,906. So we're up a little ways there. 27 average days on the market, 99.3%.
1,968.
There it is, 1968, not 1964, 1962, like when you were, born. That's what we were trying to get at. But so when we take that number, what's 1966?
I'm sorry.
1966 and 2084. What's the difference? That's the difference. So, all right. And then 27 average days. We're up 7 days. It's taking, 9. It's taking 9 days longer now, average days on the market to sell a house than last year. That makes no sense. Why is it taking longer? What are buyers doing? What are sellers doing?
Well, I think we have more supply than we did last year. So that's one of the big reasons that we're up, because if you've got more to sell, you're going to sell more, right?
Oh, yeah.
So I think that's the biggest reason that we're taking a look at. The reason it's been longer days on the market is because, same answer, supply is up. When you got the supply up and the demand is kind of remaining the same, or maybe might be a little lower, we're still looking at, taking a look at it's going to take longer to sell a house.
Yeah. So the amount of sales, Terry, has only really risen, about 5 or 6% year over year at this time. And we'll take it. It's definitely busier. I know mine, I'm almost double the business than at this time last year. It's it comes in weird waves, but the price thing is what everybody wants to know, Terry. What about the price? Last year's median was $490. This year, $470. Wait a minute. I thought we've been talking about prices have been consistently going up year over year now in Frederick County. Well, they have been, because that's the median. The median, it says no, but the average, and it also says no, because I'm sorry, 470 last year, 490 this year. So yeah, we are up 20,000. Sorry, other way. And then the average was a little different. Last year it was $520,000 is where our average price was. Now we're at $528,000. We're up about 1.6% year over year.
Okay.
We were at 2.7. We're down just a tiny little bit, maybe 1%. We've seen in the last month or two, which makes no sense considering spring and summer markets. Everybody says, Well, isn't this when there's the most sales volume and this is when prices always go up? Now, could this be because, Terry, we've seen a lot more sellers with more inventory, more competition. More sellers also with time start to realize I'm not going to get $1 million for my house. I'm not going to get 900,000. I better put it at 875. So what's happening now, I think, is these prices are up only because we've had more sellers realize that I can't overprice my house. I don't want to chase the market down. And then some of them, they're getting above asking price. I've had 2 this last week. They did that. And so how does that affect and drive the overall market of the values going up or down or staying flat per se? So we've gone from 520 to 528. Plus you get those little X factors. And that's why the median takes out the top, the high highs and the low lows, like the top 5 or 10% that are like anomaly unicorns, and then the low 5 and 10% of the market that are also kind of like, that's not the real market. But then you take that middle cut of the pie, which is like the 80% number or so, or 90%, and all of a sudden, then you get that number. So all in all, we're up. We are still going up overall, which is absolutely phenomenal. In general. But the nice part too, Terry, is that people's incomes are still outpacing the values of homes going up. People's incomes are still outpacing that. I read a thing that said it's been now 15 months, which now a lot of people would argue and say, yeah. Even though people's incomes are outpacing homes values going up, the thing that doesn't make it feel like it, and maybe not the true reality, is inflation. The cost in the last 15 months that's been happening, what the heck has inflation been? Well, it's simple. If inflation's been over 2%, then actually people are in a negative position based on both factors, housing price and inflationary items. You put those all in the same mix, 3% pay increase a year, you actually could be sliding backwards and losing ground, being able to keep up with the lifestyle, we call it. I think most people, Terry, are at least 1 to 2% falling behind every single year. And I think that's been happening at a minimum, that number, for years and years. No doubt 5 years, 4 years, 6 years now, especially when inflation got above, 7, 8, 9% for a little while there. That was just, we really started to feel the effects of how that, affects people's incomes and lifestyles and what people need to do. So I know I shared a lot there, but that was the thing I wanted to get to, was the year-to-date stuff this year versus last year. What are the differences, man? Because people want to know what that is. That gives a real true snapshot of our own backyard and what's in the backyard right now.
Absolutely. The key, let's just go back to the one key. You're still gaining appreciation. It may not be at the level that you want, but a win's a win. Whether you win the ball game by 1 point or 6 points, you're still winning the game. Losses are hard to take. Okay. If you lose by 1 point or lose by 20 points, it's still a loss. Let's keep the gains going. Let's keep the momentum going. And that's what's very important. And that's what we should take, is that we're still winning in the appreciation world.
Thank God. Yeah. And the thing is, Terry, we would have to probably see in Frederick County, we're doing a little better than most of the United States. And it would be really nice to see Frederick County, we get to like 6 or 7% a year price appreciation as a whole. That and people's incomes, that would basically put us in the black and keep us in the black pretty good for most people here. So, but I don't see that happening for a while. We'll see. All right. Mortgage updates. Rates. It's all about the rates. What's going on? Fed's meeting.
So Fed's meeting. So we're taping this on Wednesday. Fed's going to make an announcement in a couple of hours, and that's really going to turn the tide possibly on which way that we're going. There's about a 30% chance that they're going to raise the rates. Okay.
All right.
That, I believe, is not going to happen. I don't think that they can do that right now. But the question I'm getting is, why are the mortgage rates going up, but the prime rate is staying the same?
Yep.
Okay. A lot of times the correlation between the two, and it's not really a correlation, it's two different things. And I'm going to explain it. And I'm going to hopefully explain it in terms that it really makes sense to you. But let's think about this. For the first time in 40 years that I can remember doing this, July 1st was my 40th anniversary of getting into this business. Okay.
Yep.
First time I can remember where the prime rate, which today is at 6.75%. Now that may change this afternoon, but as of today, 6.75% is the prime rate. 6.76 is the average 30-year mortgage.
That's crazy.
First time I've ever remember or have seen mortgage rates higher than the actual prime lending rate. So what does that mean logically? That they should be raising the rates today. But I don't think that they can do that. So people are asking me, what's the difference? Why are mortgage rates going up? So let me just explain. First, let's understand what the prime rate really is. The prime rate is the rate that banks charge their very best commercial customers on a short-term variable loans and lines of credit. It moves almost 1-for-1 with the federal funds rate, and the prime is currently, like I said, at 6.75%. So a home equity line of credit, a credit card, things are going to be based off of the prime rate. Those are variable rates, and they move with the prime rate. Here's the difference. A 30-year mortgage, on the other hand, is fixed for 30 years. It can be prepaid at any time, right? There's no prepayment penalties.
Yep.
And it's sold into the secondary market. Okay.
Mm-hmm.
Who is the secondary market? The secondary market is anybody in the world can jump into buying mortgage-backed securities.
Right.
And they're priced off of the 30-year mortgages are priced off of mortgage-backed securities, as I just said, and not the prime rate. Generally, what I've seen over my 40-year career is that the prime rate is usually 1.5 1 to 1.5% higher than average mortgage rate.
30-year mortgage.
30-year mortgage. So the fact that the 30-year mortgage is higher than the prime today, and when I say it's higher, they're basically the same.
It's a horse race.
But it's got me really, really
scratching the head
on what's going on.
Yeah.
So here are the 4 reasons that I think the rates are basically identical.
Yep.
Number 1, investors, people buying the mortgage-backed securities. And these are people all over the world. Investors want a much bigger premium to own mortgages. Why do you think that is? Because of the risk.
Yeah, okay? The risk, right? They want more, cushion.
So they're demanding a higher spread over the treasuries. Now, we're going to talk a little bit about the 10-year treasuries, but they're demanding a larger spread over the treasuries than normal because of inflation uncertainty, right? Nobody knows where inflation is going. With the war, one day the stock market's up 800 and the next day it's down 400, then it's up, then it's down. Nobody knows what's going on with the war. I've said on the show 100 times, we got to get that figured out.
Yeah,
when that settles down. Volatile interest rates. That's another reason.
Second reason.
That's another reason that they're demanding the larger spread. And then the prepayment risk, right? So if they pay somebody like a bank to originate a loan, and then that gets paid off when the rates drop to 5.5 or 6%, that's a big prepayment risk, and that's a loser for an investor. So that pushes mortgage rates higher than many people have expected. So mortgage rates, basically, we've climbed into the upper 6% range, and prime hasn't moved at 6.75%. So the second reason is banks don't need to compete as aggressively for mortgage businesses. Because years ago, if you had a mortgage, people would say, yeah, my mortgage got sold 12 times in 4 years. Everybody wanted to buy a mortgage. Everybody wanted to be in the business. That number has decreased to probably 6 or 7. So the competition is a lot less when purchasing mortgages to basically service them. Today, refinance volume is low, purchase volume is down. Many lenders, as I just said, have left the business, but the margins remain tighter than consumers realize. So I've said this on the show, with the addition of compliance and all the regulations that the government threw on us in 2010, that raised our cost of originating the loan by probably about 0.5% per loan.
Yeah. Wow.
So that's a big reason why that gap has closed considerably. So the biggest misconception there is that the Federal Reserve influences our rates. They influence overnight rates. So mortgage investors, they care about the inflation, the
Yep.
treasury yields.
Yeah.
They look at the treasury yields. We look at the 10-year treasury, and that's what we kind of base our prices off. Government borrowing and global uncertainty are a huge factor into why the rates are in higher. Because when the bond investors demand higher yields, mortgage rates rise,
Yep.
but the prime rate doesn't. Okay. So the fourth reason is the mortgage spread is still wider than normal. So usually on a 30-year mortgage, it is traded at around 1.5% to 2% above the 10-year treasury.
Right.
Okay. So we've seen the 10-year treasury go up, up, up. So what that does is that pushes our mortgage rates up, up, up. Okay. So people think that mortgages, Darren, are like priced like car loans or home equity loans, but they're not.
Mm-mm.
It's basically a home equity line follows the prime rate, as I just said, but a 30-year mortgage is sold to investors all over the world. Think about that.
Yeah.
Those investors decide what they want in return, and right now they're just demanding more. So a couple things that I explained was basically it's closer because less competition, right?
Right.
So if you have less competition, the price is going to basically go up. So if there was, like it used to be 35 people buying mortgage-backed securities, rates would probably be down but there's so much instability in the market that the investors that are buying these loans are basically pricing them higher. And that's why we're at the same rate. And that's why the prime is not going up, but our mortgage rates are going up because the 10-year treasury is being pushed up.
I think some people would ask out there, I guess two things. Number one, if the rates for mortgages, if the Fed keeps everything flat and the same, which sounds like that's the most probable decision that's going to come out today, and you'll know this by now when you hear this, if that stays the same, but if rates keep going up and up and up a little bit, and then let's say we get back to 7% where we were before a little bit, they're gonna want to know what else shifted besides the Fed keeping things flat. So that's a good question. Now, what happens if they come down? So we've known this, and this is something that another thing you can explain to everybody, that whenever the Fed lowers the rate of the Fed, so 6.75, let's say it went to 6.50, then when the rate lowers, then the rates for mortgages, they go up momentarily. What? How did that happen? Why? And if the rates then, if the Fed rate then goes down, goes the other way. So people have always wanted to know, like, what's that all about? Why does
that happen?
Yeah, why does that happen? It makes no sense. Yeah,
because when they lower the interest rates, when they lower the interest rates, that is good news. And I've said it on the show a million times. That's good news. When people hear good news, they're going to take their money out of the safe haven of the bonds and they're going to put it towards the stock market because they know that their chance of getting a better profit is going to happen. So what happens is when you take your money out of the bond market, put it into the stock market over good news, that is basically going to trigger the mortgage rates to go up quicker. Okay. And so if there's good news, like a rate cut by the Fed, we're going to see our rates jump temporarily. Now, when the rates basically, and then they'll work their way back down and actually trend the way that the prime rate is trending. But what we will see is if we see a raise in the interest rates today, we're going to see basically the stock market take a bigger hit than it is already,
right?
Which is at 900 right now. Okay?
Yeah, there you go.
So that's going to be a problem. But what is happening is when there is bad news, people are not taking their money out of the stock market and putting it in the bond market to ease our rates. They're taking it out of the market, keeping it in cash.
Yeah, they're safe.
Sitting on the sidelines.
Sitting on the sidelines.
Because they're saying nothing's safer than cash right now.
Yeah, at the moment.
So that is the problem that we're experiencing. So it all goes back and forth.
Yeah.
Now, next week, I'm going to talk about something that, because this kind of triggered something with me. But next week, I'm going to talk about 5 things that have changed from the day I got into the mortgage business to today.
Oh, yeah, that's
40
good.
years, 5 things that have changed.
Most significant 5 things.
I'm going to talk about that next week.
Okay. The first significant thing is I was born. I got into real estate. No, I
The
wasn't.
second significant thing is I've aged tremendously in the 40 years.
All right. We got about 3 minutes left. All right. Oh, my. It's all fun and
So did I
games.
explain that? Like
Perfect. Yeah.
Okay.
Oh, yeah. That's great. There you go, guys.
I don't
You
want
just
people
heard
out
it.
there going, was that Charlie Brown's teacher?
No, that was good stuff right there. I don't think it got missed now. There is no mistaking what's going on. Now you know the trend of the markets, right? All right, Terry, a couple minutes left. What the heck happens as a seller buyer when the worst thing that could ever happen, the sky is falling, we missed the settlement date. We can't settle on the date of the contract. What happens? Does it mean the whole dang thing just blows up? Does it mean the sellers can't sell their house? Does it mean the buyers just, oh, well, you ain't getting the keys to the house, or they just walk away? We're just not going to go to settlement. There's a party down at the beach. We're out of here. I'll tell you what, Terry, I've heard it all. I've seen it all, but let's get the numbers down here. It's never good news typically. I mean, sometimes it can be. That's very typical 98% of the time. It ain't good news. What percentage of settlements do not close on time? Well, it depends. Now, pre-COVID, everything we talk about sometimes, Terry, we like to benchmark it and compare it to COVID. Pre-COVID, post-COVID. I don't know if our kids are going to be doing that in 30 more years saying, hey, I was born pre-COVID.
Yeah, well. Yeah.
I don't know. We'll see in 40 years. I may be dead and gone. But check this out. This is a big number. How many homes, how many transactions failed to close on time of the designated settlement date? That's time is of the essence. 23% out of 100 settlements, 23 did not close on time. Terry, right now, it's 13% of all contracts experience a delay in a settlement. Now, 99% of
say 15 to 18.
Yeah, you're close. 13. 6% of the contracts were terminated and they just never closed. So that's that number. But therefore, roughly 81%, they do settle on time, which is a pretty good number. So the big thing we're going to talk about coming up next week also, Terry, and continue on with this is the big one. What are all the reasons that a settlement does not settle on time? What are those common ones? What are the most integral ones? And guys, you do not want to miss this because I'm going to bring solutions to a lot of these things and scenarios, but I will end the program on this today. I'm dealing with one right now, Terry. You can't make it up. If a seller leaves the country or goes away anywhere and they do not assign power of attorney and they do not sign the documents legally required and get them back to the title company and here to the U.S. or wherever, or the title company, we've got a major bueno problem because you got to have that done in time. So that's huge. That can delay things, and so can some other things. So we're going to get into all that next time. Thank you guys so much for listening, and happy buying and selling with your Frederick Real Estate Update. Take care and have a great weekend. All right, guys. Thanks so much. We'll see you soon.